In New York City, I'm Julie Hyman, that's Josh Lipton, and this is Yahoo Finance Live. Here's what we're watching this afternoon. Stocks heading into the final hour of trading with some modest gains here. All the major averages notching 52-week highs in today's session. The November CPI report showing inflation is cooling down from a year ago, and investors are now turning their focus to tomorrow's Fed decision.
Plus, gasoline prices falling to their lowest level of the year. We're going to take a closer look at what's happening in the commodity space as oil prices break below $70 a barrel.
And it's been a tough year for home buyers, of course, as the American dream slips away thanks to low inventory and high mortgage rates. A new report, though, highlights which markets will be best for 2024. We'll tell you where they are and why they'll be more affordable in the new year. Let's get you up to speed on the market action at this hour. With an hour left in the trading day, as we mentioned, some modest gains here for the major averages. Right now, we've got the Nasdaq up about 0.5%, the S&P up about 1/3, the Dow up about 0.4%. That's about 146 points. I'm looking at the groups on the move here today. Energy and utilities are in the lagging position once again today. That's really what we've been seeing for the year, and we're seeing it again. Materials, tech, and industrials are helping lead the pack today. So that's what we're watching on the sector level. But Josh, really here today, there is the digestion of the CPI figure, and then the look ahead to what we're going to hear from the Fed. That's effectively what's going on here.
Yeah, we did get that, the big November CPI print. It came in, about as expected. Core CPI, so ex food and energy costs, which is what, of course, our central bankers prefer to focus on, increased 0.3% from a year ago, climbed 4%. I think it was the kind of print, Julie, it didn't really change probably anybody's mind on either side. We've had very smart economist strategists come on and say, you know what, it's moving in the right direction. It's moving fast enough in the right direction. They'll say, we think cuts are coming next year, maybe March or May. We've had others say, it's not, not so fast. It's not receding as rapidly as you think. And that's why they think if cuts come next year, it's probably in the back half. I think this print, again, basically clocked in roughly as we thought. I'm not sure it changes much on either side right here.
There was some interesting commentary from Krishna Guha, who is the vice chair over at Evercore ISI, and he said at the margin here, because as you say, it doesn't change anything writ large, but he does say the absence of a benign surprise, he says, could reinforce what we anticipate will be the Fed's inclination to drag its heels and lowball rate cuts for next year. He's seeing a 2-cut median baseline for next year. So he's looking, as have so many people that we've been talking to lately, at the potential for the Fed to disappoint the markets with the timing, the pace, and the number of cuts next year. But of course, we're waiting for tomorrow to see if we get any more color on that, all of that.
Yeah, there'll be a lot of focus on what not only what the Fed does, but of course what Jay Powell says, and where he sees what he says about the jobs report, what he says about this report, where he sees the kind of trajectory of inflation moving from here. In that report, I do think under the hood there was some interesting kind of puts and takes. Shelter prices rising like that. You do need to see shelter moderate if you want to get back to that target. So where shelter prices we think head from here, a huge part of the story.
Yeah, definitely. All right, let's talk a little bit more about what all of this means. For more on the CPI report and the market action, not just today, but going forward, we turn to Brad Newman, Alger Director of Market Strategy. Thanks for being here with us in the studio. So you look at that CPI print today, you look at what we've been talking about, these dynamics over Fed cuts next year. And I know you tend to drill down and look at individual companies, but what's your sort of macro read on all of this?
Well, I think when I was on your show earlier this year, we looked for inflation to come down and for interest rates to be less of a headwind. And since that time, inflation's about halved from 6% to 3%. I think if you look under the hood of the inflation report, it was pretty good. If you strip out not just food and energy, but also shelter, which we think lags real-time home prices and rents by about 12 months, it's running about 2%, which is pretty good. So, I like to look at it in 3 buckets like the Fed does. Goods, and goods has been in deflation for about 6 months now. In fact, there's outright deflation in China, so I think there's good reason to think that goods prices will stay under control. Second bucket would be shelter, and we know that, as I said, is lagging and should continue to move down. I think it ran something close to 6% this month, and so that seems far too high relative to what we all know is not home prices increasing that much. And then the third bucket's kind of like the stubborn core services bucket, which hasn't really come down enough, and that's the one that we really need to break for the all clear sign.
And so, Brad, for you, are you sort of, as I was just talking with Julie, are you in that camp that says, okay, when they look at core, it's receding rapidly enough that you think they can cut, let's call it March or May, or do you think, no, it's going to be a bit more, that last mile, 2% is going to be a bit more stubborn? If they do cut, it's probably a second half event.
I think March is probably a little too early. I think if inflation ultimately comes down to something like 2 to 3% on a core basis, then I think they'll be able to cut sometime next year just to bring real rates down. And I don't know whether that's second quarter or third quarter, what have you, but sometime around then.
Okay, so given all of this then, what do you do with your money right now, and what do you recommend the clients do? I know that you've been looking at the sort of big secular trends, right? Thematic stuff like AI, but when we talked to you earlier in the year, you talked about some of those names. Has that calculus changed?
So when I was on earlier in February this year, we talked a lot about AI and how it's this general purpose technology similar to the internet or electricity, and mentioned a lot of those names have done fantastically well. The NVIDIAs, the Microsofts of the world. I guess I would look for that to broaden out a little bit. So those stocks were kind of like ground zero for artificial intelligence, meaning they were the infrastructure, the hardware infrastructure, the software cloud computing infrastructure. And I would look for that to broaden out to adjacencies that are maybe a little bit less obvious. For example,
would you rotate out of those or just expand?
No, just expand. We still like a lot of those leaders and think that there's more fundamental growth left there. We're just broadening out that theme to encompass adjacencies like power and electricity. So we think that artificial intelligence is a big user of electricity. In fact, we think it's going to go from about 3% of total electricity consumption in the US to about 10% by the end of the decade. And that, along with electric vehicles and other demands on electricity, may cause some shortages and need some infrastructure build out. And so companies like Eaton and Schneider, who work on modernizing the grid and will help provide power to data centers and others who need it as generative AI takes off, those companies we think will be in demand. Other companies that provide cooling and efficiencies for data centers like Vertiv. So those types of companies we think will be in demand.
What about another theme I know you like, Brett, heading into 2024, small caps? What's the thesis there?
So small caps have been really hurt by what we call the duration trade. So as interest rates increased, companies with their cash flows furthest in the future were really hurt, just like a 30-year bond was hurt more than a 2-year bond. And so small cap growth was a poster child for that, and is now trading at a pretty big discount. Historically, small cap growth trades at around a 10% plus premium to the stock market, and now it's trading at a double-digit discount. So those stocks are unloved and out of favor, and we think that they should outperform. I believe that they should outperform over the next year or two.
And at the same time, what do you think the relative value of stocks versus bonds is looking like going into 2024?
Well, large caps still somewhat attractive relative to bonds. I do think that the correlation between stocks and bonds will decline from its very high levels. I don't think the market will be as focused on lower interest rates being so good for stocks, so I think that correlation will be reduced. So large caps look okay relative to bonds. I think bonds have a place in a portfolio. As the correlations come down, the 60-40 type balanced portfolio will look better. But small caps, and in particular small and mid growth, look, I think, very attractive relative to fixed income.
All right, Brad, thank you so much for your time today and those stock picks. That was great. Appreciate it.
Thank you.
Moving on, let's get some tickers. Cava shares surging today as the IPO lockup expires. Cava insiders now able to sell their shares. You can look there. It's up more than 14% in today's trade. So, Julie, a couple things. One is, it's been a nice run since that June IPO. Moving higher today, the lockup expired. Most analysts covering this name are fans. They have a buy rating, 8 buys, 4 holds, and 0 sells right now.
This is weird. Let's just say it. This is weird. It is unusual to see a lockup period expire and a stock go up, especially go up this much. Usually what a lockup period expiring means is that insiders, as you said, can now sell the shares. If the idea is that they're able to sell the shares, then that would put pressure on the stock, but that isn't what's happening in this case. Now, we have seen the stock go down a little bit in the days running up to this, so perhaps you had already this sort of reaction beforehand. But it's unclear to me exactly what is going on here. As you say, folks are very bullish on it, and we did see the stock IPO at $22 in June.
So it's been a nice pop.
It's been one of the certainly outperformers within the IPO universe, if you will. So I've got emails out to a couple analysts trying to figure out what's going on here. So if we get an update, I'll come back and try and figure out what's going on. Let's talk about Moderna, too. Those shares are falling after the company announced a reorganization. It's working to drive sales of its COVID-19 vaccine. One of those changes is the departure of the company's chief commercial officer, Arpa Garay, who just joined in April 2022. And effectively, CEO Stéphane Bancel is now going to be kind of taking on that role, taking on a sales and marketing role. The street does not seem to like this, given the reaction that we're seeing in the shares today. Basically, that raises some questions about the strategy of the company that it would need to do this and the departure.
Yeah, I mean, Moderna's been under a lot of pressure. I mean, this stock is now down more than 50% this year. I think there's just broad questions about what the plan, the business looks like in kind of this post-pandemic world where, sales of COVID vaccines are slowing. Now, Moderna, we know, is looking to expand, new vaccines for flu, for cancer. But remember, just last month, they told investors they're looking for revenue to drop next year, and in fact said they're looking for revenue to drop worse than the street was banking on. So you've seen them under pressure. It's been tough going, and not a ton of confidence among analysts either covering this name.
No, definitely not.
All right. Last one here, shares of Airbnb, they're edging lower in today's trade. That's after a downgrade at Barclays, the team cutting the stock to underweight from equal weight on a cautious travel outlook for 2024. So Barclays, not believers, they were at equal weight. Now they go to underweight, which is so equivalent of a sell. Their target goes to 100. What they say is they have data, Julie, telling them that the short-term rental demand is plateauing, maybe even worse than plateauing, and competition from hotels is increasing. And what it sounds like is they're just kind of just generally more cautious on travel broadly heading into 2024.
Yeah, just basically overall, it sounds like the slowing of the trend that we have been seeing. And they're also talking about the regulatory pressures that we have seen on Airbnb, right, where in certain cities they've sort of cracked down on the ability of people to Airbnb their properties. They said we expect EBITDA growth to slow and normalize, and multiples will likely come down even if the premium to peers persists. Again, that's that note from Barclays, the analysts there led by Trevor Young and Ross Sandler. You've been talking about some of these other picks and what the kind of street vibe is. In this case, there are 6 sells on Airbnb, which is about 15% of the analyst ratings, and about 54% of them are at a hold rating. So about 32% are at buys. So that's kind of how it breaks down.
Yeah, we should note that Barclays also downgrades Expedia to equal weight. The stock that's a stock that just roared this year. It's up more than 60%. So the analysts saying, listen, it now makes sense to lock in some profits.
Yeah, it looks like they like Booking as their overweight pick here.
Yep.
So we'll see. They said stick with scale in terms of what to like within travel. We're just getting started here on Yahoo Finance Live. Coming up, ahead of the new year, we're counting down the top 10 stories of 2023. We're going to reveal number 7 later in the show. You got to guess? And the top housing markets for 2024. We're going to dig into the areas in the U.S. that could see double-digit growth in the new year. Plus, Google's epic fail in the courts yesterday. We'll dive into the results of Google's antitrust fight with Epic Games and tell you what comes next. We've got much more coming up.
Google had an epic fail in the courts yesterday after being found to have an illegal monopoly in its App Store. The unanimous verdict from the jury sided with the video game maker Epic Games after it claimed Google used its dominant position to squeeze excess payments from game developers. Search giant now plans to appeal that decision, and our next guest believes it could make Google be in Google's favor. Adam Kovacevic, the founder and CEO of Chamber of Progress, joins us now. So, Adam, it's good to see you. So listen, get right to the headline. The Google loses this big antitrust fight with Epic. I'm interested, Adam, just get your take on the jury's verdict and also what you think the judge's punishment for Google could end up looking like.
Sure. I think there is certainly a headline appeal to this story. It's a loss for Google. It's one of the few losses that they've had in court, one of the few big tech losses. It's not a case brought by the government. There's been a lot of attention to the cases brought by Lena Khan, Jonathan Cantor against big tech companies. This is not like that. This is a private antitrust case brought by Apple that started 3 years ago, or brought by Epic, started 3 years ago. They brought a similar case against Apple, which Epic Games lost. But here, before a jury, not a judge, Epic prevailed. And I think it certainly is a loss for Google, but we'll see how this unfolds, because I think that one of the things about these App Store cases is that fundamentally, they're not particularly about consumers. They're mostly about App Store commissions. And Epic would like to not pay Apple or Google's commissions on App Store transactions, particularly in-app purchases on gaming. And so at the end of the day, we may see that Epic gets to perhaps get more percentage on those transactions, but that's fundamentally what we're talking about here. How much money is going to go to Google and how much money is going to go to Epic for these in-game transactions?
Well, I mean, I guess you could argue at some point that the charges overall for consumers could be better, right? The cost they pay could be better depending on the economics for the individual players. Be that as it may, I think everybody's just trying to figure out what happens now, right? If Google does appeal as it's expected to, then what, right? If this comes before a different judge.
Yeah, great question. So the first step before an appeal will likely be the remedies phase. And so early next year, the same judge will have to determine, given that the jury has found Google guilty, what are appropriate remedies. The judge has already said he is not going to try to micromanage the commission fee that Google charges to app developers. And so, for example, whether or not Epic pays 30% or 29% or 15%, that's not going to be a subject that he's going to decide. But what we may see instead are policy changes. So changes to the rules of how Google runs the Google Play Store, and particularly around in-app billing. One of the things that Google has been rolling out as a pilot program over the last year is alternative in-app billing besides Google Play. So a developer could allow other forms of billing besides Google Play's billing. I think it's very likely that we could see a remedy in this case look something like that, right? Provide Epic and perhaps other gaming services with these basically user choice billing options besides Google Play billing.
And Adam, I'm also interested to get your take. What was the difference between this case and the Apple Epic case, in which there Epic mostly lost?
Yeah, well, I think the biggest difference is that this was a jury trial and the last one was a judge trial. So at the end of that trial, we had a 50-page opinion from a judge. At the end of this trial, we have a 8-page questionnaire that the jury filled out. And so, we don't know much about the jury's reasoning. They didn't have to grapple with a lot of those questions. I do think there are differences between the Apple model, which is more of a closed ecosystem, and the Android ecosystem, which is more of an open one. And some of those I think might have played into the jury's analysis here. But it's important to say that if Google appeals this decision, it appeals it to the Ninth Circuit, which is the same judge that affirmed Apple's win against Epic in its case. And I think you may see that the Ninth Circuit has to grapple with how these two cases could come to different outcomes, and particularly this question of whether iOS and Android truly compete with each other, because in the Epic case, the jury found that Android does not compete with iOS, but in the Apple case, the judge found that Apple does compete with Android. And so they're going to have to potentially grapple with that on appeal.
And Adam, I want to get you out of here on this, kind of switching gears in this last question. These reports, Adam, that Apple is now offering to let rivals access its tap and go mobile payment systems tech in Europe. I'm just curious to get your take on that, Adam. It looks like, trying to settle these EU antitrust charges there, but how, in your opinion, this would kind of work? Would this be, kind of Apple just goes region by region and would kind of just carve out Europe here?
Well, it's important to say that this is something that hasn't really been pushed for by consumers. It's been pushed for by PayPal and other competing payment services who'd like to be able to access the NFC chip on iPhones and process payments the same way that Apple Pay does. Of course, people have lots of ways to process payments on a phone. They don't have to use the NFC chip. They could do it through QR code. They could do it through other means. But I think this is not terribly surprising given Europe's general direction on tech regulation as part of the Digital Markets Act. They have shown little hesitation to kind of intervene to help a competitor, regardless of whether or not that's beneficial for the consumer. I think we're going to see with a lot of these European actions, there may be some downstream consequences in terms of security and other things that the regulators maybe haven't fully grappled with. But right now, their focus is pretty squarely on, how can we help maybe the competitor who's in front of us who has lodged complaints. And I think that's what's at play here.
Adam, good to see you. Thanks for your insight as always. Adam Kovacevic, founder and CEO of the Chamber of Progress. Thank you.
Thank you.
Well, today's CPI report showing energy prices cooling in November, and that's leading to a big win for consumers at the pump. Yahoo Finance's Inez Ferre has a look. Thanks, hi, Inez.
Hey, yeah, Julie, a lot of fast there. Here we go. We're looking at the CPI index with the gasoline component of the energy index, down 6% on a year-over-year basis. Now, the gasoline component within that energy index, that was the biggest decliner on a month-over-month basis. And if you just take a look at gasoline prices, you are seeing that they have been on a downward trend since the middle of September. In fact, today's gasoline price, the average nationally, is at $3.14. That's the lowest level of the year. And you have about 17 states or more that are seeing gasoline prices below the $3 threshold. So if we take a look at some of the other components within the energy index, we are seeing that gasoline down 8.9% year over year. 6% was the month over month. And then we're also seeing some of the other components that are down even more so year over year. Natural gas, which is down about 40% year to date. This is on a month over year for the month of November. And then fuel oil, which is down 24%. And that is attributed to the price of oil, which we have seen oil very volatile this year, guys.
Yeah, yes, I just want to follow up on that. What is the latest in oil? It looks like we're cracking $69 here.
Yeah, and you are looking at oil prices down more than 3.5% with WTI Brent crude also lower. Look, you've got a lot of concerns about demand now, and that's demand coming out of Asia and demand in Europe, which has seen a slowdown, and some people are saying recession in Europe. So this is because of demand. It's also because of the lack of conviction of what the market sees when it comes to the OPEC plus cuts. There wasn't a lot of uniformity there. And as far as I spoke to one analyst that he was telling me, look, if you start to see oil prices going below $60 a barrel, then you can expect OPEC plus is going to come back out much more unified next time as far as production cuts are concerned, guys.
All right, Inez Ferre, thank you as always. Appreciate it.
Thank you.
And coming up, more Yahoo Finance after the break. 2024 is shaping up to be complicated for the venture capital industry and startups. Our next guest says the theme to watch is going to be a surge in startups shutting down. Joining us now is Don Butler, Tomvest Ventures Managing Director. Don, it is great to see you. Kind of sounds like a bleak forecast there for startups in 2024. Why is that?
Well, if you go back and you look, what we had in 2021 and 2022 was we had a surge in startups that got funded. Like one thing we track is, in the same way the housing industry tracks new home starts, we track new venture starts in the form of Series A financings. And what's happened is that we saw this great bubble in companies that were formed, and they were kind of formed under a different regime. And in terms of the mentality, it was all focused on growth, even if they're burning quite a bit. And then we've had this massive regime shift. And then what you're starting to see now is you're seeing those companies that raised in 21, call it 2.5 years worth of venture capital, coming up towards the end of their capital run. And so they've tried to cut burn and cut expenses to make capital last longer. But at the same time, you have a revenue environment that's gotten more difficult, especially for a lot of software companies. And so now you sort of have this, and that matched with a third factor, which is that just the number of venture dollars being invested has come way off. So suddenly you have a very large cohort of startups competing amongst each other and looking at supply of capital that is significantly shorter. Like one of the metrics we saw was that the demand for capital versus the supply of capital is about 3-to-1 ratio. And so for every dollar that a venture company is looking at, there's about 30 cents on offer from the venture community right now.
Wow. So how does that play out exactly? So do you expect then a lot of startups to just shut down? Will you see actually some buyout activity where you see combinations perhaps, or larger companies coming in and buying them as maybe valuations go down? How does this all play out?
I think kind of a combination of all the above. One metric that caught my attention was we're at about a decade high in terms of the number of actual startup shutdowns. So if you look at PitchBook data, so far this year there's been about 3,200 startups shut down. That's probably somewhere between 6 to 8% of the total venture community actually shutting down in just this year. And then on top of that, what we're seeing is, if you look at the number of financing rounds that happen compared to the height in sort of Q1 2021, financing rounds themselves are off about 50% for Series A, B, C, D. And so you have this very large cohort coming through where the financing rounds basically aren't happening. If they are happening, about 18% of them are typically down rounds. And so you have the remainder that are shutting down. We've seen some companies go back to investors and say, I'm going to shut down because I don't think I'm going to get there and I'm going to hand back capital. And then the one other part that's made 23 difficult and looks at the outside of 24 to be difficult is you don't have the same exit environment or the M&A environment. And for a while, a lot of us in the venture community sort of expected that you might have M&A roll-ups funded by the big private equity firms. I think one of the problems has been with the cost of debt being so high that M&A roll-up activity is off as well, like PE activity is off as well. And so, you don't have sort of this clear exit environment for companies. Now, one thing I would say is that we've seen some, not the larger companies, not the Salesforce of the world, start to embark on lots of startup acquisitions. I think when they've done acquisitions, they've been more transformational. But we've started seeing acquisitions by like the tier 2 public companies. Think companies that might have 2 to 5 billion of market cap that have got a good growing business that are starting to do tuck-in acquisitions of like 100 million. So we do see some green shoots on the M&A environment, but there's not a clear place to go with a lot of your companies. And so for us, having just come off our year-end planning session, one of the metrics we're starting to track is how many of our companies have actually gotten to cash flow break even or net income positive. Because really, if you can't count on the exit environment necessarily being there, then you sort of count on your current investors and cutting capital and growing into a point where you actually can dictate your own outcomes.
Yeah, and Don, you're kind of going where I was headed, which is when you see more startups kind of shutting down next year, are there certain kinds of startups that are more at risk there, sectors, industry, financial profiles?
Yeah, it tends to be, I think, people who have not been able to grow efficiently. A lot of the companies where, and it's actually sort of ironic, one thing we've seen in fintech is we've done fewer later stage investments this year simply because the quality of the companies didn't seem to be there. And it's almost like if a company had to come, there was a later stage company and had to raise this year, there was almost like adverse selection. Like they were coming because they weren't able to cut expenses and continue growing and get the break even. And so you're seeing the companies that were not quite as interesting. And so I think certainly we've seen some impact in fintech. We've seen some impact in places like insurtech. I think one area that we did not invest in, but I sort of see it running parallel to areas we work in, has been in sort of the whole crypto environment. And I suspect we'll see a lot more sort of damage in that ecosystem as well.
Is this sort of just part of the cycle, right? I mean, is this, in other words, if you're looking at a lot of startups shutting down, once again, we're looking at maybe a weak pipeline of companies that will enter the public markets, et cetera. Is this just kind of what happens periodically, or is there some kind of bigger takeaway about the health of that pipeline?
I think personally, and I started in February of 2000, so old enough to sort of date myself in cycles now. I would say that it's part of the natural cycle. We seem to have like 7.5 to 10 year cycles in venture where there's kind of boom and bust and boom and bust. The one thing that's very different this time around is that the industry has gotten so large that it's almost like you see the boom and bust happening, but at scale. And to me, that's the thing that feels very different. It's just the sheer number of companies that are out there now. The cohorts in the last few years have gotten so large. And one thing we did was, when it was apparent that there was a downturn happening back in 2021, we did a study of startup rates, the rate at which they would go from Series seed to A to B to C, the graduation rate. And what we found was the extent to which companies were flush with cash didn't necessarily increase the rate at which they kept on going to the next stage, but what it did do was it increased the total number of companies. And so I think part of the headlines you'll see next year will be around just the sheer volume of companies that were funded and then the ones who are coming.
Well, just quickly then, does that mean a bigger economic impact because of the scale?
I think so. Simply, I think, and it kind of depends on context. We've been through several downturns. I was asked earlier today by somebody who said, how bad does it feel? And I was like, well, having been through this, it does not feel as bad. And actually, compared to 2021, this doesn't feel bad at all. On the other hand, when I talk with colleagues in the industry or entrepreneurs who started their companies in like the last 5 years, I think it feels terrible. And from their perspective, it's like, gee, they've never seen it so bad.
Right.
All right.
Shorter time horizon.
Yeah, for sure. A big important trend. Don, thank you for your time today. Really appreciate it.
Thank you very much. Yeah, thank you. Thanks.
Well, the November Consumer Price Index showing inflation slowing down from a year ago, or the rate of it anyway. Joining me now, our own Alexandra Canal and the National Economic Council Director, Lael Brainerd, joining us as well. Director Brainerd, thank you so much for joining us. So we are looking at, even though you can talk about how it was versus estimates, we are looking at inflation data that broadly is moderating, right? At the same time, when you look at how consumers are feeling, it's still very much a mixed picture. How should we think about that gap, if you will, between the data and between the sentiment out there?
Yeah, well, as you said, I think the inflation data is very encouraging. 2/3 decline in inflation down close to 3% now, and that taking place against a backdrop where unemployment has been below 4% for the longest stretch in 50 years, and growth is strong. So the overall picture, I think, is a good one. But we know that many American families still are finding many things to be unaffordable, and that's very much why President Biden is focused on lowering costs for American families. And if you look at where Americans are concerned, areas like prescription drugs, where we are working hard to bring costs down, and areas where there are hidden fees, like in banking and airlines, where we're working to get rid of junk fees. So, as you say, good progress, but we've still got work to do.
Dr. Brainerd, another area of concern is shelter. The shelter index accounting for nearly 70% of the total increases in core inflation. Rent prices also remaining very sticky. And you said it yourself that there's an affordability issue here for Americans. How does the White House plan to address some of these problem areas in the housing market?
Yeah, so housing is one of those areas where we really need to see some improvements on affordability. We're going to be pushing very hard on that. We are seeing some reduction in rents, particularly in new rents, so that is encouraging. But we still need to see much greater supply of houses that are affordable to bring those rents down. That's why we are pushing very hard for tax credits and other incentives to make those affordable housing areas more prevalent, zoning changes. We've got some good programs that are starting to take effect there. But we also want to make sure that first-time home buyers really have a chance to buy their first home. And so we're very focused on down payment assistance and other ways to bring costs down for those first-time home buyers.
Of course, Director Brainerd, not just in your current role, but in your time at the Fed as well, one lesson is you can only control what you can control, right? So you can do some of those things at the margin, of course, to help with affordability. How optimistic are you that you're going to get some of those measures through? And if you don't, what does the trajectory for home ownership look like in the United States?
Well, I will say that market rates are already coming down. Mortgage rates have come down by nearly a full percentage point over the last few months. So that is encouraging. And in terms of house affordability and expansion of affordable housing, there's bipartisan interest in that. So I am hopeful there. We are taking funding that's available for transit. We're encouraging housing development near transit to solve both the affordability of housing challenge, but also access to good jobs. So I think there are a lot of things in the pipeline that will make a difference. And on some of these other challenges like prescription drugs, we're already taking action. The president already secured really important legislation, insulin prices coming down to $35 a month from $400 a month for so many Americans. Out-of-pocket costs are going to be capped at $2,000 for our seniors. And Medicare will start negotiating the first 10 drug prices. So in that area, I think the legislation is going to make a big difference.
And by and large, the economy has proven resilient. We've seen that in the jobs market. The bull case is strengthening that we could navigate a soft landing. But what are the biggest risks to the economy in your view that could derail some of that strength?
Well, I will say that supply chains, which were the biggest risk during the pandemic, are so much more resilient today because of all the investments that have been made in infrastructure under the bipartisan infrastructure law, but also the actions that have been taken in areas like shipping and trucking. So if you look at supply chain resilience, it's much better today than it was a few years ago. So that's very encouraging. Obviously, we'll keep our eyes out for risks coming from geostrategic challenges abroad, and we see a number of those. But generally speaking, because of the president's Investing in America agenda, a lot of private sector investment will continue to contribute to productivity and broader economic growth. And of course, that translates into good jobs for Americans.
Well, let's pick up on the job point a little bit, because that is one area of concern for some economists, right? That we could start to see that unemployment rate tick up more and more. I don't know if you heard the interview just before yours, but we were talking about potentially some closures within the startup industry, for example, next year. We certainly have heard anecdotally about some layoffs here going into the end of the year. So how high a concern is that for you?
Well, of course, individual companies, you'll see churn there, and that might create some challenges for employees. But if you look at the broad picture of the U.S. labor market, what you see is a picture of actual remarkable resilience. We've seen 2.8 million more Americans coming back into the labor market over the course of the last year. That is completely contrary to predictions that many people had that, Americans weren't going to come back into the labor force after the pandemic. Well, they have, and they've exceeded working age participation rates, so that's very good. If you look at the quits rate, it has now come down to the pandemic levels. All of the other indicators that I look at certainly suggest a labor market that looks pretty well balanced. Of course, we'll be tracking that very closely in months to come. But for now, on the back of that solid growth that we've seen and still resilient consumers who have stronger balance sheets, I continue to anticipate a solid job market going forward.
And sticking with that job market, wage gains, that's been a consistent headache for the Federal Reserve, but at the same time, a good thing for consumers that are battling higher prices. What's the view from the White House when it comes to really navigating that and balancing that?
Yeah, so real wages have gone up over the course of the last year. Non-supervisory workers have seen over a percentage point in wage gains adjusted for inflation, so that's very positive. That said, if you look at the overall picture on compensation growth, it's actually been moderating and is growing in line with productivity, which has strengthened a great deal. So I really see the wage picture as generally quite benign for American workers. Strong union contracts this year, of course, and not a source of inflationary pressure for the broader economy.
Lil Brainerd, thank you so much for joining us with your perspective. Director of the National Economic Council, really appreciate your time, and our own Ali Canal as well. Coming up, thank you. Coming up, the Magnificent Seven stocks took a hit in Monday's trading session. We'll dig into the why after the break. The Magnificent Seven in focus on Wall Street as the largest names are coming off an unusual day on Monday. The S&P 500 was higher, yet all seven stocks were down on the day. Yahoo Finance's Jared Blickery has a look at what's behind the move. And the conventional wisdom goes that stocks overall can't rise without these guys.
Yeah, the Mag 7 have been such an instrumental part of the rally this year that it was really weird to see half of our heat map, which is those Mag 7, just completely red while the S&P 500 was up. First time that's happened since 2012. And of course, back then, Mag 7 wasn't even a thing. But I'm talking about the Nasdaq 100 today because we're going to be rebalancing Monday. And we had an announcement over the weekend, and Barclays has kind of sifted through the tea leaves to see exactly what's expected, how much buying and selling of the new issues versus the old issues that are going out has to happen. And fitting to that, the Nasdaq 100 is up almost exactly 50% year to date, and it is at a record high. It's set for a record close only today, I believe. So let's take a look at these notes here. This is Barclays saying that there's going to be a lot of selling, and this is what was started yesterday in Apple. $4.7 billion billion. Microsoft, $4.1 billion. Alphabet, ANC, put them together, $2.5 billion. NVIDIA, $1.76 billion. Meta, just a smidge. And Tesla, some net buying of $2.9 billion, but it was expected that there would be up to $5 billion more. So there was a bit of surprise on Wall Street that the managers of the Nasdaq 100, and it is a managed index, it does have rules, they have decided to take away some of those concentration worries. Now, I want to show you the stocks that are leaving the Nasdaq 100, and when I show you the year-to-date performance as I have here, it's kind of obvious why. JD.com down 55% in the midst of an index, as part of an index that's up 50%. Well, China has had a lot of trouble, and so the index is shedding JD.com. Enphase Energy, that is a solar plus EV play, that's down 62%. Lucid Motors down 38%. Even Zoom, once a pandemic darling, that could only muster 5.2%. That is gone. eBay, a stock that's been around since 1999, that is gone as well. And Align Technologies. And then here are the additions, and you can see quite a change here. DoorDash up 106%, relatively new issue. CDW, I remember those computer catalogs from when I was a kid, up 21%. Splunk, a software company, up 76%. MongoDB database up an even basically 100%. So you put all this together, and hopefully we're going to have a much more stable NASDAQ 100 next year, although I think the people complaining about too much concentration, anything that drives an index to 50%, well, that's a problem to be had, guys.
Jared, thank you so much. Appreciate it. Moving on, shares of Zscaler, they are trading higher today after an upgrade from Macquarie. Macquarie upgrading that stock to outperform and taking the price target to 231. This coming amid rise in cyber threats. We're joined now by the analyst who made that call, Fred Havemeyer, Macquarie head of U.S. AI and software research. Fred, it's great to see you. So you are officially a Zscaler believer. Walk us through the argument, Fred. Why is Zscaler a buy here?
Absolutely, and thank you. What we did is we upgraded Zscaler on the back of both our fundamental work on the company's overall financial profile and its long-term margin potential, in addition to a deep review of all of the trends that we see driving the cybersecurity industry. And so we think that right now is the correct time to be upgrading Zscaler from our prior neutral to an outperform rating with our new $231 target price, because of imminent new SEC reporting rules that come into effect next Monday, December 18th. Under these rules, companies that experience a material cyber breach, data breach, will need to disclose that that breach occurred within 4 business days. We believe that Zscaler, in addition to protecting against the manifold threats that are out there in an increasingly adverse cyber threat environment, we believe that Zscaler is able to help companies, and especially C-suite, better understand their cyber risk and connect the dots when there are material financial events related to their cyber risk, therefore helping them meet these new SEC reporting requirements.
So basically what you're saying is that these new reporting requirements are going to drive more companies, motivate more companies to take on Zscaler and engage them for their services, effectively because they would have to disclose things that they're not now having to disclose. And it would create, negative sentiment and other sort of bad knock-on effects.
And also in a timely manner. I mean, 4 business days is a very short amount of time to turn around a breach investigation and try to determine materiality. I think in the background of all of this, one thing we call out is that the SEC recently charged SolarWinds chief information security officer with fraud allegations on the basis of disclosures that that company had made, particularly as it related to disclosures to investors and disclosures in an 8K. So without digging into SolarWinds specifically, we think that that case, in addition to the upcoming and imminent new SEC reporting requirements, really is a shot across the bow for CISOs and the broader technical C-suite in general, that now their disclosures for data breaches can have really significant events if they don't manage their liabilities with very good analytics and understandings of exactly what their cyber risk looks like. So yes, we do believe that in the background here, demand trends will be supportive of uptake for Zscaler, both to mitigate the massive ransomware attacks that are continuing and ongoing and growing year over year, as we cited in our report, but also specifically of Zscaler's Risk 360 solution, which can connect the dots between cyber risk and financial exposure.
And Fred, let's talk about valuation as well here. This stock, it's It's roared in 2023, Fred. It's up about 90%. It just hit a 52-week high. How does valuation look to you, Fred, versus peers? I mean, you obviously still think constructive.
Yeah, so I tend to cover the very growthiest spaces. And I think that even within that, when we take a look at the balance of Zscaler's growth and its margin potential, we still see upside here. So at the core of our upgrade, we took a look at the long-term margin potential of Zscaler to see where there might be more room in our model. We found that in the long run here, when growth slows at maturity, that we estimate Zscaler can achieve a mid-40s% non-GAAP operating margin, which gave us the opportunity to raise our target price. And when we take a look at the background here, really what we're doing is we're saying that at the least, Zscaler should be worth about as much as other cybersecurity and DevOps cloud and software peers, such as CrowdStrike, such as Cloudflare, and also Datadog. So we think that there's room both on a valuation basis and on a fundamental basis.
And Fred, for that matter, do you think that while you think that Zscaler is uniquely well positioned here, do you think that these new rules are going to be a boon for the whole industry?
I think in general, it is a constructive tailwind for the cybersecurity industry. I think that if we just take a look at the big picture of what's happening here, I mean, the attacks are very large scale. One thing we particularly called out that's absolutely fascinating is that some of these cyber threat actor groups are almost forming cartels at the moment, where central ransomware as a service providers, essentially the black market analog of a software as a service provider, are now actually setting rates for how they expect all of their own consumers to charge victims of ransomware attacks based on the size and the scale of organizations. So we see in the background of all of this more coordination among attackers, increasing levels of attacks, and now new SEC reporting requirements that require very timely disclosures. So we do think that this is a constructive, rather sets up constructive demand tailwinds for the entire cybersecurity industry, for those best of breed platforms, and companies also that can provide real-time analytics and risk visibility.
Fred, good to see you. Thanks for joining us. Fred Havemeyer, appreciate it.
Thank you.
Coming up, the closing bell on Wall Street. We'll check in on the latest market moves and the top trending tickers, so stay tuned. All right, there's the closing bell on Wall Street. Let's do a quick check of the markets here to see where things close out. Is that the Greek flag there at the New York Stock Exchange? I believe it was. If I know my world flags, I don't know if I do, but there we go. And we've got the major averages higher here today. The Nasdaq up 0.7%, the Dow and the S&P each up about 0.5%. As we spoke about earlier, energy and utilities, the laggards today, tech, materials, financials, industrials, a good old-fashioned cyclical advance here within the major averages as we watch what they're doing. And, yesterday, if you recall, at the close, we talked about the major averages being at their highest since various points since 2022. So they're up again today. That means they've hit those new highs once again. So at least 52-week highs for each of the major averages after CPI this morning, going into the Fed remarks that we're going to be getting. So should be interesting.
Last scheduled Fed decision for the year.
Let's see if Jay Powell pours cold water on all of those expectations for early Fed rate cuts next year.
We'll be watching. All right, let's get to some moving tickers today. Shares of Johnson Controls International, let's start there, sliding following its fourth quarter results. Company missing estimates on the top and bottom lines. Company also reporting lower than expected earnings guidance. I think that was key here. It does come down, it sounds like here, Julie, to the forecast. Adjusted earnings for fiscal 24 below what the street had been looking for. So the company, which makes fire, heating, cooling, and security equipment, sees $365 to $380 a share. Street was close to $392, it looks like. And they reported Q4 results as well.
Yeah, and we were just talking about cyber threats, right? Yep. And that was one of the issues for Johnson Controls. It had undergone a cyber attack, and there was some optimism or hopes that that effect would be limited, but it sounds like it's going to stretch into the first quarter. That's part of the reason why the forecast is below estimates. So that's something that analysts are talking about. And analysts are also talking about weak demand in China as something that is weighing on the firm. So not surprising then to see the pressure that the stock is under in today's session. It's one of the worst performing stocks in the S&P 500 on the day.
And Citi, interesting as well, by the way, in a note to clients saying the company needs to do a better job in under-promising and over-delivering on what appears to be solid underlying demand, but they stay on the sidelines. Citi is neutral. Target is 61. Not a great year if you're long this name. Stock's down about 20%.
Oh, yeah. All right, let's look at Zillow as well. That stock is getting a lift after analysts at JMP Securities upgraded it to market outperform from market perform. The firm noting consensus estimates for Zillow are too low for 2025 and 2026 here. And they did acknowledge that recent ruling that we heard about that affects kind of the structure of the real estate industry and how commissions are paid out to brokers. They said that could cause some volatility in the short term, but that Zillow ultimately will hold up okay.
Yeah, the key line here for them, I think, seems to be we believe consensus estimates are too low for 25 and 26, given, they say, pent-up demand, increasing expectations that rates will begin to come down in the back half of next year. Though, to your point, Julie, they do acknowledge, listen, the stock could be volatile here in the near term on those headlines about antitrust litigation.
Exactly. Yep. Well, I mean, we keep talking with housing expert after housing expert that says things have to eventually get a little bit better.
Point.
So one would think that Zillow would benefit from that.
All right, we're going to end here on shares of Oracle dropping today. Dropping is the nicest way we can put that. You might say hammered, crushed, down more than 12%. Company missed adjusted revenue estimates as cloud sales in the second quarter disappointed. So even the bulls on the name were certainly disappointed with this print here, saying this was disappointing. The top line miss, driven, they said, by weaker than expected OCI revenue. So they're referring there to Oracle Cloud Infrastructure, which is their public cloud servers competing with all the big guys, Amazon, Microsoft. You did hear Oracle management. They talked about their pipeline, Julie, big deals on the way, but I know at least some analysts felt like they just had more questions than answers after that call. Yeah,
I mean, the company has really banked its future in part on cloud infrastructure, and that growth was just not what analysts had been predicting here. The company kind of said, well, it was because of capacity issues, not because of demand issues, but still, that didn't really mitigate declines. The stock ultimately having its biggest intraday decline since September 12th. I just checked to see if it finished off the lows of the session. It did but not by much. At its lows, it was down 12.5%. And it finished down 12%. So
yeah, it had a nice run into the print. It was up about 40%, but getting shelled today.
Yeah,
sure.
definitely. Let's talk about another story that we are watching that continues to develop. Choice Hotels launching a hostile takeover bid for Wyndham Hotels and Resorts. The budget hotel operator announcing what's known as an exchange offer for Wyndham shares. Yahoo Finance's Brian Sazzi, he's here with us, and he had the chance to speak with Choice CEO Patrick Pacious on this takeover battle. Saz, what are some of the takeaways from your conversation?
Well, for me, Julie, I think the mud is starting to be flung around this battle here very well. And I think you really getting the sense that Wyndham, which is the larger hotel operator, 9,300 locations, of course, they own Hojo or Howard Johnson's for your younger folks out there, Super 8. They probably do not want to be acquired by the smaller Choice Hotels, which has 7,500 locations. You also have Stephen Holmes, the CEO over at Wyndham, longtime executive there, was the former CEO. Now he's running point on this board battle. But I asked Choice Hotels, Pat Pacious, if this deal really is getting contentious, and then ultimately, if the deal does get done, can these folks work together? Here's what he said.
Deal negotiations, everybody knows they can be tough at times and laborious, and getting through the work here is important. But we know that management team well. We respect that management team. We like what they've created. It's the reason we want to make a combination of both companies together. And we see an opportunity on the other side of this to continue to work in tandem with them.
And guys, really the main contention, I think, from a Wyndham standpoint is, can this get regulatory approval inside of an election year? Now, I think what Choice is arguing is that their hotels are really owned and operated by small business owners. They set their own prices, so they will not be causing any monopoly. And then secondarily, they're going up against Marriott and Hilton, two giant behemoths. So they're trying to create really the third largest hotel chain in this country. I don't think this deal is getting done tomorrow. I think Wyndham is playing its hand very well. They have a pretty good offer here, and I think Choice is willing to offer a little bit more.
And so that's interesting, though, the bottom line, Brian, because I know there were questions about whether even this happened, the kind of regulatory scrutiny they'd be under, but they're saying, listen, they don't see that as a real meaningful risk.
Yeah, and here's a couple quick takeaways on this one. I do think ultimately this deal will get done. It makes sense. You have Hilton and Marriott, which have both done tremendous jobs expanding their loyalty programs, and I think these two companies have to combine and create a great loyalty program for middle-income America. It will take time. Again, I don't see this happening over the weekend. I think Wyndham has to find a price that it's comfortable with, and then also in terms of a breakup fee as well. Choice has come forward and offered $435 million. Doesn't seem to be enough. And then lastly, like I mentioned, a deal does make a lot of strategic sense here. You have to find some way to better compete with too much larger chains.
I mean, I know it's a different regime, a different administration, but we've seen other mega deals get. I mean, Marriott Starwood is the biggie, right? And so it would be difficult to see something like this get rejected when again, I know it's a different administration, but still.
This is Wyndham, I think, just trying to drive the price up even more. At the end of the day, you have a board over at Wyndham that has fiduciary responsibilities to get as much money as possible out of Choice Hotels, if that's what it is. Maybe a deal gets done at 95, and that might sound like a decent number.
Travel's been hot.
Very hot.
Yeah.
All right, Brian Sazzi, thank you, sir. Appreciate it.
Thanks.
Switching gears, investment firms Vanguard and Arjuna subpoenaed by the House amid the investigation into potential anti-competitive behavior in environmental, social, and governance investing. This coming amid growing criticism of the space. BlackRock CEO Larry Fink recently snapping back at political claims, accusing the firm of deterring American energy companies from drilling for oil. As pressures mount, we're taking a look at the muddy road ahead for ESG investing. And here to discuss all that is Ethan Powell, Impact Shares CEO. Ethan, great to see you.
Thanks for having me.
Let me ask you just about that headline we just referenced. House Judiciary Chair Jim Jordan, so he subpoenas Vanguard, wants more information, I guess, on the company's ESG policies. I'm just interested what you make of that news, what it means for the space.
Well, look, it's an interesting year for ESG. You started the year with rampant accusations of greenwashing by the private sector, followed by the Supreme Court overturning affirmative action in colleges, which really impacts DEI initiatives across the board. And now you've got Congress waging these antitrust claims against some of the larger asset managers. So it hasn't been easy, and this is really an extension of what historically has been a fight in the executive branch, which is typically driven by the Department of Labor and their definition of fiduciary duty and whether or not ESG is consistent with fiduciary duty. So at the end of the day, we're politicizing everything in society, and ESG is really on the front lines relative to the financial services industry.
Well, and even before this latest wave, right? ESG has had trouble sort of gaining traction, right? Even people inside the industry.
Absolutely.
You know, there's issues with definitions of ESG. There's been criticism of lumping E and S and G all together. So how does the industry kind of move forward and make a case?
Well, look, I think it starts with the realization that every dollar consumed, every dollar invested impacts the world around you from a social and environmental perspective. And the problem is we all have different social and environmental priorities. So saying one strategy is ESG and another is not really reflecting our own individual perspective on how we want the world to sort of evolve. So what we need to really do as a community is stop talking about ESG in isolation and saying, how intentional do you really want to be with your capital allocation relative to the impact in the world around you? And if it's not intentional at all, go invest in cluster bombs, right? You know, and if it is intentional, you as an investor need to clearly understand what that intention is and understand the people, process, and philosophy associated with the investment strategies that you're investing in, and is that consistent with your non-financial goals?
Ethan, I reached out to Morningstar to talk about ESG, and they gave me a really interesting stat. I want to run it by you about your space. They said the third quarter was the first time, Ethan, that more sustainable funds liquidated or removed ESG criteria from their investment practices than were added.
Yep.
That sounds like a really sharp about face to me, a reversal. I mean, that tells me Wall Street's closing ESG funds, they're scrubbing ESG criteria. I mean, walk me through that. I mean, I assume it's multifactorial, the reasons. What are they?
Yeah, well, look, I think it starts with, if you rewind 2 to 3 years ago, sort of the gold rush within ESG, and every firm was racing to launch strategies. And the challenge with that is ESG is very, very nuanced, and it takes a concerted effort by your distribution, your marketing, and most importantly, your portfolio management teams to ensure that you are actually doing what you say you're doing, and the investors are getting what you say you're delivering. And I think with the regulatory scrutiny, you know, certainly the SEC made it a priority over the last couple of years. It scared particularly a lot of the bigger names away because they realized that it was much more nuanced than what they were treating it as, because frankly, some of the names were just converting existing strategies, you know, potentially getting rid of a sector or two and then calling it ESG, which really isn't consistent with the investing public's expectation of really legitimate ESG strategy.
So let's talk about it through the specific prism of impact then, because I'm looking, for example, at your YMCA Women's Empowerment ETF.
Sure, yeah.
And I'm seeing a lot of familiar names here that I gotta say, I don't automatically think, oh, this company does women's empowerment,
Sure.
right?
Right.
So like, you know, Amazon's on here, Apple's on here, Meta's on here, you know, which Meta has definitely come under fire for some of its practices on its social media platforms with regards to young women. Procter & Gamble, McDonald's, like, how do you figure this out?
So we always start with what's the process and who's behind it, right? And within the name of the fund, it's the YWCA.
Oh,
right?
did I say YMCA?
You did.
Oh
but
my
that's
gosh.
fine. That's fine. And they have 160 years of advocating for women in communities of color, right? So what we do is work with these leading social and environmental advocacy firms, help them express their perspective in our social screening criteria, and then an important element of our portfolio construction is that every sector in the economy is reflected in the same general weighting as our equity market proxy, which is the Russell 1000, right? And why that is A, we want to effectively engage every sector of our economy, right? Because to your point, women in tech, there's lots of firms that have controversy around that, right? And we want to demonstrate, okay, these are the things a tech company can do to advance women, right? And then also, you know, primarily is you can have a risk return that is more consistent with a known bogey, which in this case is Russell 1000. And in the case of our YWCA Women's Empowerment Fund, you know, it's first percentile since inception, right? Beating 99% of the large cap blend category. So, you know, for us, you are empowering this organization to have a spot in the boardroom to meaningfully engage the private sector while simultaneously having industry-leading performance.
Ethan, I want to get you out of here on this question. When the market is in sort of rally mode, how does that sort of impact an ESG money manager? What I mean is, listen, if you're in a down market, I would assume people stop caring a little bit less about ESG. They start focusing on, listen, I just don't want to lose what I have. Right. So how does sort of the general market backdrop factor in here?
There's definitely a wealth effect, right? And the way we talk in terms is if you think of the efficient frontier, risk return, for every unit of risk, there's an optimal amount of return. We talk in terms of a third dimension, which is the social and environmental implication of your capital allocation. Well, what ends up happening in a down market where the wealth effect is impacted, people start to emphasize risk and return more than the social and environmental implication.
Right.
So, but it's here to stay. The demographic switch is just going to make it more and more meaningful, and to attack it the way I think it's been attacked over the last couple of years is, I think, longer term a fruitless exercise.
All right, Ethan, it's a big, important conversation. Thanks for stopping by. I appreciate it.
Thank you.
And coming up, we're counting down here the top 10 stories of 2023. We're going to reveal number 7. It's right after this break. We're counting down the top 10 stories of 2023 here at Yahoo Finance, and coming in at number 7, Sam Bankman-Fried goes on trial.
Sam Bankman-Fried pleaded not guilty to federal fraud charges.
It's going to be an uphill battle for Bankman-Fried and his defense team.
Sam Bankman-Fried's bail has been revoked and was immediately handcuffed and placed in custody.
Sam Bankman-Fried found guilty of all 7 charges.
The jury clearly was receptive to the government's case, was not persuaded by Bankman-Fried's testimony, and we saw that with their swift verdict.
2023 brought the anticipated criminal fraud trial of FTX founder Sam Bankman-Fried after the collapse of his crypto exchange in 2022. The time came for Bankman-Fried to make his case in court. Here with how the case unfolded is Yahoo Finance's Alexis Keenan. Alexis.
Yeah, guys, so it's been exactly 1 years since Bankman-Fried was arrested in the Bahamas, and he was charged, as we now know, with these 7 counts of criminal fraud and money laundering. And they were federal charges alleging that the reason that FTX imploded was because Bankman-Fried and his top executives were taking money from the exchange that was put there by customers, by lenders, by investors, and used it to push over to his sister crypto hedge fund, Alameda Research, which then in turn spent the money on lavish real estate, multi-million-dollar real estate, multi-million-dollar political donations, as well as risky crypto investments. Now, it was this year, though, that this New York City criminal trial unfolded in October over a 4-week period. And the justice here for Bankman-Fried was really swift. He pleaded guilty in January, and it was the beginning of November by the time the jury agreed with the Justice Department here, saying that he was guilty of these fraud charges. The charges carry 110 years in federal prison. And you had Sam Bankman-Fried's top executives turning against him, taking plea deals with the government, and saying that they participated in this scheme that brought this $34 billion exchange down to a $9 billion deficit, to the point where the exchange could not return customer funds.
I mean, this was just a stunning story. I mean, when we count down the top stories of the year, this one is a no-brainer to be on the list because it kind of had everything from a story perspective, although unfortunately for the people involved, had a lot to affect. I mean, you know, the fact that SBF was romantically involved with one of the people who testified against him, who was running the hedge fund.
Caroline Ellison, yes.
Caroline Ellison, the fact that a bunch of them were living together in the Bahamas.
He was hanging out with celebrities like Tom Brady. He became part of our pop culture. And look, this was one of the largest financial frauds in U.S. history, so certainly significant. And also, you know, this really became, Bankman-Fried became the face of what is a much bigger, a much wider government prosecution and crackdown on the crypto industry. You saw the CEO of Binance make a guilty plea to DOJ charges that are money laundering related, paying a huge fine there, $4+ billion. You also had the SEC going after Grayscale, Coinbase, and Ripple, not always succeeding, but definitely trying here. And Bankman-Fried, though, absolutely the primary target in this enterprise.
And Alexis, the bankruptcy hearing tomorrow is just spinning ahead. What do you expect there? And the bottom line question of whether these customers are going to get their money back.
Yeah, so tomorrow is another day in court. It's a typical day in court. It's an omnibus hearing, but we should get some updates about how much money the exchange has recovered. So far, it's the last we heard was about $7 billion+. So customers hoping to get some money back there. But look, the exchange has to pay back its lenders as well. There's a lot of people standing in line, customers not certainly at the front of that line. But it's a general hearing. We should learn a little bit more about the fate of this company as it works its way through the bankruptcy process.
All right. The headline of the day from Bloomberg, by the way, Sam Bankman-Fried's lawyer says client was the worst witness he has ever seen. So
I mean, it's not exactly a surprising headline, but it is and it isn't.
He was not a star witness.
No,
but
you were
maybe
there, Alexis.
didn't have a choice either.
Yeah, Alexis, thank you so much. Appreciate it. Moving on here, a tight labor market and cash flow restrictions are the biggest headwinds for private companies heading into 2024. Those are among the key findings of a new study from Deloitte today, which asks C-suite executives what their priorities are for next year and where cuts will be made. Joining us now is Wolf Tone, Deloitte Vice Chair, U.S. Global Private Leader. Wolf, thank you so much for joining us today. That one stat that struck at me, Wolf, right away was 60% of private company leaders think cash flow is going to limit their ability to hire the next 12 months. Wolf, what'd you make of that data point? Were you surprised by it?
Hey, first and foremost, thank you very much for having me on today. I'm not sure if I was shocked by the data point. It actually was supported by a recent survey we did this past summer, in which cash flow was certainly a challenge. Raising capital was a challenge. And while 60% of the organization said that cash flow would limit their ability to hire, 2/3 said that they were having trouble attracting and retaining talent. And even equally interesting was that when you started to slice into those numbers a little bit more, you found a bifurcation between large companies and small companies. Those organizations with under $200 million in revenue were finding almost double the difficulty in finding the right level of talent. 3/4 of the organizations were having difficulty finding local talent despite having fairly robust hybrid strategies. And so organizations are turning to different ways to attract and retain and reskill their existing employees.
I mean, that suggests, though, that there is still demand out there for those workers, right? Although, the data point that Josh cited is a little bit different there, that cash flow is the limiting factor. You're suggesting that there is still the desire to hire out there, but that there are other limiting factors.
That's exactly correct. The majority of the surveys that we took found that organizations were still ready and willing to hire. The challenge was trying to find the right individuals for the skills that they needed. The areas of technology and productivity remain critically high, but trying to find that talent and having the capital to pay was becoming more challenging.
But Wolf, if I may, sorry, I mean, this has been a refrain that we have heard ever since the onset of the pandemic, that this has been an issue. Has it gotten better, worse, the same? How does it compare?
I would say that the issue of employee retention, having the right employees, remains challenging. And it's not necessarily just employees, it's employees in the right areas. Areas like, as I mentioned, technology is as organizations move to digital transformations, as they adopt large cloud-based solutions, as they start thinking about the impact of AI and having the right infrastructure to adopt those technologies, individuals with the capabilities and the skill sets to serve in that area is critically important. And quite frankly, just organizations can't find those individuals in their backyards, and they're looking elsewhere to try to do that, including reskilling their own employees.
And Wolf, give us a sense too, and you hinted at this, but the kinds of private companies you're surveying here, Wolf, how big are they by revenue?
By revenue, the survey that we conducted is from organizations call it from 100 million up to $1 billion. We did not go over $1 billion in revenue, so there's still a fair amount of larger organizations that are out there, and quite frankly, just aren't part of the survey.
One of the other headlines that struck us is that not only are people having trouble finding people to hire, but there are also private companies planning layoffs. In fact, about 2/3 of the private C-suite is planning layoffs next year?
There, if you in the data, it will say that less than half really are looking at reducing their workload. What we found is that more were thinking about retaining or hiring additional employees and ensuring that they've got the right work environment, including whether it be hybrid or non-hybrid, whether it be the right culture, apprenticeship programs, reskilling. It was really a laundry list of different areas, but organizations remain rather bullish, and which was fairly representative of the private company market, which is resiliency.
If I may, lastly here, I want to ask you a little bit about demand in your business, because there was the news today from the Wall Street Journal that one of your biggest competitors, EY, was planning on laying off partners. Now, there are some structural issues there where it was going to split and now it's not, but that still prompts me to ask what you guys are seeing in your business.
You know, and I still remain bullish on our business, just like the companies that we serve. Well, I won't speak to what some of our competition is doing. I certainly will speak to the survey that we conducted, and the fact is that we are in a challenging time. There are certainly economic headwinds, but there are demands and needs in different areas. And just like the companies that we serve in Deloitte Private, there's a demand for increased productivity and a demand for technology expertise.
Wolf, thanks so much. Wolf Tone of Deloitte. Appreciate your time today.
Take care. Thank you.
Coming up, the top housing markets for 2024. We'll dig into the areas in the U.S. that could see double-digit growth in the new year. Next. Steep housing prices making the dream of buying a home unattainable for many Americans, but there is some optimism for some areas across the country in 2024. Realtor.com recently out with its top housing markets for next year. And joining us now, Realtor.com Chief Economist Danielle Hale. Danielle, it's good to see you. I guess we're all moving to Toledo, Ohio for the second year in a row, it seems, according to what you guys are looking at. I mean, it is interesting. The persistence of strength in some of these areas. What's driving it?
Yeah, I think that's right. We have seen the affordable markets in the Midwest and the Northeast, not the biggest cities, but the secondary markets where homes are more affordable, really do well in this housing market where home prices continue to remain high nationwide and high mortgage rates are really stretching buyers' purchasing power, in some cases to the breaking point, except not so much in these areas where buyers' dollars really stretch further and buying a home does still feel possible.
And Danielle, what are some cities or metro areas that maybe took a hit this year that you all think, you look in your crystal ball, you look out at 2024 and you think they may be poised here to bounce back?
Yeah, so our top housing markets list comes into two major groupings, essentially. Affordable markets in the Northeast and Midwest, like Toledo, like Rochester, New York. And then you've also got a pocket of markets that are expected to do well in Southern California, where home sales have really been sluggish as a result of high home prices and high mortgage rates. They've had not only rough 2023, but also rough 2022. And so we expect to see that area begin to bounce back as mortgage rates turn the corner more convincingly, which we expect them to do in 2024. And that reduction in mortgage rates is going to help improve conditions for buyers in Southern California. We're not going to see a return to pandemic levels of home sales activity, but we are going to see a nice bounce back in those markets.
Danielle, what are people doing in these places? In other words, right, are people moving to a place like Toledo and looking for a job because it's affordable, or is it expansion from nearby other cities where people can maybe telework? What phenomenon is driving, because obviously people still need jobs when they're in these various places?
Yeah, it's really a mix. Some of these markets do have homegrown local buyers that are able to take advantage of stronger employment conditions in the area. But a lot of times it's people coming from nearby markets. So in Toledo, you might get buyers from Chicago, for example. In Rochester, you see a lot of buyers relocating from New York City, sometimes even Boston, looking for affordability and trying to find more space for their real estate dollar. You'll notice that the top market in Southern California, for example, is the Oxnard, Thousand Oaks metro area, which is just outside of the LA area. So again, we see that theme of people looking for affordability, maybe willing to tackle a longer commute in order to get there so that they can find a place to live that still falls within their budget. And this is especially true as hybrid work remains the norm in many markets. Even though we're not seeing as much full remote work as we did in previous years, hybrid work enables people to tackle those longer commutes so that they can get more affordability from the housing market.
And there was a good story in the Journal this week that had a lot of people talking, and the piece said how home ownership in this country is now a pipe dream for more Americans. Their words, that just the math for buying a home between the high prices and the high rates, it doesn't work anymore for a lot of Americans. What was your response to that, Danielle?
Yeah, so buying a home has become more challenging. It's one of the reasons why, even though we do expect an improvement in affordability in 2024, we don't expect to see a huge uptick in home sales nationwide. Some of these markets will see home sales go up, but nationwide, we're expecting just a 0.1% increase over what we saw in 2023. And for context, we expect sales in 2023 to tally the lowest that they have at least since 2008 and possibly even stretching all the way back to the mid-90s. So it's a tough place to buy a house right now. Some people look at the overall home ownership rate and think, the overall home ownership rate continues to be relatively high. People must be doing okay. But if you drill down and look at the home ownership rate by age, you can see that an aging demographic population is masking real significant challenges for younger potential buyers who are not yet homeowners, but who likely aspire to be. And so, I think the Journal has probably hit on some real significant challenges in the market and the stress that it's causing a lot of younger households.
All right, Danielle, thanks so much for joining us today and giving us that outlook for what to expect next year. Appreciate it.
Absolutely.
And coming up, we're wrapping up 2023 with the top trending Google searches of 2023. We're going to reveal what they were. It's after the break.
Welcome to Yahoo Finance's group chat. I'm Josh Schaefer along with Alexandra Canal and Brooke DePalma. And today we're kicking things off with more layoffs in the labor market. We've got EY and Hasbro joining the ranks of high-profile companies, reducing their staff numbers. You can see Hasbro there cutting about 1,900 in 2023. That's obviously a total number. Hasbro did not cut 1,900 yesterday alone when they announced those layoffs after the bell. Hasbro stock closed down about 1% after cutting about 20% of the staff overall now. And interesting, I think, just to sort of think about layoffs. We started the year talking about layoffs a lot, right? Started 2023 talking about tech layoffs, and layoffs becoming a bigger story here in the last month.
Yeah, started the year talking about layoffs. Seems like we're ending the year talking a lot about layoffs. And I think about my beat in particular, which is the media sector. Disney, they laid off 7,000 workers throughout the course of this year. Spotify announced 3 separate rounds of layoffs. Now, a lot of this comes amid several restructuring efforts on the part of the companies. This push to profitability, Spotify always one of those businesses that struggle on the margin side, and CEO Daniel Ek has always preached efficiency. And that's something that we're really seeing across the board, no matter the industry, not just tech, also media, also financials. It's an interesting place to be. We have this super tight labor market, though, and you wonder if this could maybe be the first signs of it cracking as we head into 2024.
Right, and that story translates to retail, to fast food, to consumer-facing companies. McDonald's earlier this year announced accelerating the organization part of it's accelerating the Arches strategy, what they dubbed as 2.0, and part of that was a significant layoff around the April timeframe after they announced an investment in restaurant development. I think a lot of these companies, we also saw Gap, we saw Best Buy, we saw VF Corp, we even saw Boeing also announce layoffs this year, and many of which are really just figuring out how they're moving into the next year, how they're going to streamline operations, how they're, as you noted, going to become more efficient and ultimately double down on jobs where the future is going. Is it AI? Is it restaurant development? It certainly is growth. It's the name of the game for fast food. And so making sure that their employees meet that demand now.
And that's an important thing, I think, to take out of this conversation for me is sort of, we're talking about specific companies and how they're dealing with higher rates, right, and costs going up and sort of how they're managing that. But when you think about like the overall job market, as Ali mentioned, still relatively tight. Yes, we're slowing down, but the unemployment rate's at 3.7%. That's historically low. Yeah. Weekly jobless claims, which is one thing economists track for layoffs, right, overall, at about 220,000. If you look at weekly jobless claims going back to last November, they were about 220,000. So we've been sort of in this broad range. And that's what economists are watching into 2024 is, do these headlines that we see turn into actual things in economic data where you get the unemployment rate up closer to 4.5%? Does initial jobless claims go up to 250,000? And then you're talking about a full labor market slowdown. Right now, I think it's just companies. We're just seeing certain companies do this, and it's not necessarily a full slowdown just yet.
Yeah, well, we'll have to keep tracking that. But another thing we're tracking today is Netflix doubling down on its viewership transparency. On Tuesday, the streaming giant released its first ever biannual viewing report that covers 6 months worth of data and includes the following: 1, hours viewed for every title, both original and licensed, watched for over 50,000 hours; 2, the premiere date for any Netflix TV series or film; and 3, whether a title was available globally. And there's some interesting stats in here with season 1 of The Night Agent amassing that top spot, while other Netflix originals like Ginny and Georgia and Wednesday also outperforming here. And this is the first time we're really seeing such comprehensive data. And the licensing picture of this all is interesting to me because 45% of those top titles are licensed titles. And Netflix hosted a press call with reporters. I asked co-CEO Ted Sarandos whether or not Netflix would ever consider licensing their own originals to competitors. We've seen them licensed from others. Suits, prime example of how well that does. And he said no. He said the fact that Netflix has this search feature, which makes it really easy for people to find their content, they have a large subscriber base, that makes these licensed shows explode. He's not quite sure if the reverse would have the same effect.
I do think, just like speaking from a consumer standpoint, you do find that on Netflix, right?
Right.
Like, the suggestions they make, you always kind of click on them, and they have that
explore them, watch a few minutes.
The popular on Netflix tab is pretty prominent the second you get there, and so they can kind of steer you in that direction. I don't know. It'd be interesting though if they did license it out to other streamers at some point. Sort of what kind of interest that would garner. Like, did everyone that wanted to watch Stranger Things just get Netflix?
Right.
Or would you see like a resurgence? Because all of Netflix's shows are new.
More churn too for a
and all of Netflix's shows are new, right?
Yeah.
I think that's sort of what stands out to me there is all of those shows have really come out in the last couple of years, it feels like.
They've
versus
only been making originals for about a decade.
the shows that they license,
Comparatively,
you can kind of bring back, Lost that was popular maybe 15 years ago and make it popular again.
Yeah, and when I think of Netflix, I can't think of some that have done so well over the past year. I think of Ginny and Georgia. I think of Bridgerton. That was one that got me hooked, and honestly, it has me rethinking when a new season comes out, do I want to pay for Netflix again? Because I was one of the ones that got the boot earlier this year as well. But 2023, there's lots going on, and unfortunately, it is coming to an end. But Google has been sifting through our search history as it reveals the most Googled subjects for the year. And among those in the top spot, sports, spots, and entertainment are, drumroll please, Travis Kelce, of course, and Barbenheimer. Now, among those that were also on top lists include Damar Hamlin, Barbie in general, Shakira, and some top news stories include that war in Israel and Gaza.
Overall win here, Mattel again. Like just seriously though, like to get a 6-year-old toy to be the top Google search among movies is so impressive because when you think about how Google works and you Google Barbie, yes, you're getting the movie, and even if you're Googling Barbie Showtimes, you're getting the movie, but what's the third thing down the Google search? Probably some Barbie merch, right?
Yeah.
And so like for that play to be able to win Google that way, really impressive.
And it wasn't just Barbie, it was also Oppenheimer too. So the
Barbenheimer. People were wondering what that was exactly. I have to admit, I probably Googled it as well.
It just goes to show, though, the pop culture phenomenon that happened this summer for the box office. This is an industry that has really struggled, especially amid the writer's strike. I mean, it couldn't have come at a more important time for theaters, and the fact that we saw so many people wanting to know what this was, the hype, the marketing, everything around it, it just worked so perfectly. I don't know if you can recreate that, but it'd be truly amazing if you could.
Now, while people did not search Taylor Swift, because everyone knows who she is, people did search her new boyfriend, Travis Kelce, to wonder how they could get on the hype of the NFL.
Well, this answers the TikTok argument that was going around, right? Of like, is Travis Kelce even close to as popular as Taylor Swift? Easily not.
He's on a global
I
scale.
think Swifties were Googling him to be like, literally, who is Travis Kelce?
The NFL is an American sport. I mean, globally, Taylor Swift is doing concerts in Brazil, everywhere. She is the moment, and some are saying that she put Travis Kelce on the map. So I don't know.
Yeah, tough question, because did he put
We'll have to
her
bring
on
this
the
discussion
map?
back on National Tight End. It's a big day for football fans. But coming up next, we're going to tell you what you need to watch tomorrow. We're going to break down the stories you need to know to start your day ahead of a big Fed day.
X, the social media platform formerly known as Twitter, is reportedly expected to bring in around $2.5 billion in advertising revenue this year, according to Bloomberg, and that would be down from the original target of $3 billion projected by X executives. It comes as companies such as Disney, IBM, and Apple pulled advertising from the platform after a Media Matters study showed their content was shown next to anti-Semitic posts. So this one comes from Bloomberg, Julie, citing sources. They do know ad sales still making up around 75% of X's total revenue. So that is still obviously very much the lifeblood of this company. And we know some advertisers, including some big ones, have gotten uncomfortable with the platform under Musk's watch.
Right, although to be clear, the figures that they're citing here are from the first 3 quarters of the year. So don't really, and as we know, most of the time advertising, even digital advertising, is you buy ahead. You're not buying for this particular moment. So we could see more of a hit in the fourth quarter, but even $600 million per quarter is down sharply from the $1 billion run rate that the company was seeing not under Musk's leadership. Now, there are some caveats here. The company has said, gave a comment to Bloomberg and said these numbers are not representative of the business that we are now. Musk himself has said he doesn't want to rely on advertising. They have subscriptions. There's other, irons in the fire that we don't know exactly what they are, but he says that he has other irons in the fire. So it's unclear if there is a more robust revenue picture that we're not seeing. But it seems pretty clear that the advertising part of it is not going as it was.
Yeah, that's the big question, I think, is what does the business look like looking ahead? What are the economics of it? What's going to be driving it? Is it advertising? Does Musk see subscriptions playing a bigger role? AI? Is it some combination of the three? Dan Primack over at Axios recently wrote about this. And Musk actually responded to him saying, I have never lost money for those who invest in me, and I am not starting now. So sounding as confident and defiant as ever, Mr. Musk.
Yes, so we'll see what happens with that. Let's talk about another billionaire, shall we? And his venture, Blue Origin, the space technology company founded by Jeff Bezos, is preparing to launch its new Shepard rocket for the first time in over a year. The company is saying on social media that it's targeting a launch window that opens on December 18th here. This, it sounds like, is going to be a cargo mission that's going to carry research and scientific payloads, and it's had about a 14-month hiatus here because it did have a failure during a cargo mission back in September of 2022.
Yeah, so it sounded like there was that malfunction, and now from these, it sounds like changes have made, those issues have been addressed, and they're ready for liftoff. We should know that the Blue Origin apparently still needs the green light from the FAA, and it isn't clear, based on the reports I'm reading, that's happened yet. But the return mission, from what I'm reading, that, as you noted, that'll carry payloads, not passengers. Though maybe this is the first step to the return of that as well.
Yeah, it has flown passengers in the past with New Shepard. 31 people passed the edge of space.
Yeah, if given an opportunity, would you take a space tourism flight? No, why not?
I'm all set.
No.
I don't feel like it's a safe endeavor as of yet. I'm good.
No, really? Okay, fair enough.
Yeah.
Yeah, I wouldn't either, but I get seasick in bathtubs, so it's not going to work for me. All right, moving on. Time now for What to Watch. Wednesday, the Fed having its last policy meeting of the year. Fed Chair Jerome Powell will speak to reporters after the decision. The market forecast the central bank will hold rates steady. Moving over to the earnings front as well. Adobe, that's a big one, reporting earnings for Q4. The company's earnings have consistently grown over the last several years, and analysts are forecasting another gain. More economic news as well. We'll be getting the latest PPI data, a look at inflation on the producer level. Economists expecting prices to rise slightly from October to November, potentially dulling soft landing optimism. But something we're all optimistic about is our continuing Yahoo Finance series. Tune in for our latest installment of Goodbye or Goodbye, where we help navigate the best moves for your portfolio. Also on Yahoo Finance, we're counting down to the new year with the 10 biggest stories of 2023. Tune in tomorrow for a look at the headlines that defined the year.
You have any guesses for what's on the? I mean, we know. I guess we know. But you can tweet at us if you have guesses as to what the other top stories of the year. I mean, SBF, no-brainer.
Yeah.
Twitter becomes X.
Yeah.
Big
those
one.
Those are easy ones.
Those were easy ones. So if those were easy, then theoretically the top one should be even easier.
I would think
for people to guess.
Tune in and find out.
Yeah, you can tweet at Yahoo Finance, at Jules Hyman, at What is Josh Lipton, isn't it?
Joshua H. Lipton.
Joshua H.
Yeah, come on.
Are you going to tell us what the H is
Of course not.
for?
I'm not saying that live on camera. What are you, nuts?
All right. With that, we'll leave it. Today's Yahoo Finance Live. Be sure to come back tomorrow. We will be here an hour earlier at 2 p.m. Eastern. And that's because we've got the Fed meeting tomorrow. We're going to hear from Jay Powell, so that should be a fun one. So join us for that. Have a great night.